My name is Dave Popowich. I'm one of the analysts here at CIBC. Very pleased to be joined today by Tourmaline Oil Corp, represented by President and CEO Mike Rose. I don't think Mike needs much introduction. He's had a long and successful career in the Western Canadian gas industry. Tourmaline, of course, now is the largest producer of Canadian natural gas. So it's certainly been a very interesting story over the past couple of years, and it's about to get a lot more interesting. I'm sure we'll touch on that today with the spin-out of their infrastructure assets. I'll hand it over to Mike to make a few opening remarks. You're welcome to touch on whatever you like, but we've got the slides here, and we'll launch into Q&A after that. I would just also add, similar to other presentations we've had today, we do have an app that you can download and submit questions if you'd prefer to submit questions anonymously. Of course, if you raise your hand, I'll also try and reach out to you as well. So take it away, Mike. Thank you.
Thanks, Dave. So welcome, everybody. I'll just touch on a few of the slides in the COV, and I won't go over every detail on this slide where we tried to put the entire deck on one slide. But Tourmaline, 11 years of operation, and we've gone from zero to a senior-sized producer at over 300,000 BOEs a day. We've gotten there by drilling 7% of the inventory we have, and we're 2.4 billion BOEs of 2P reserves, booking 15% of what we have in inventory. So we're really just getting going. We exited 19 at 315,000 BOEs a day, which is within our full year guidance for 2020. So it'll be a very strong year production-wise in 2020 with sequential quarterly growth. Where we sit after 11 years is 3 giant core resource plays, all completely de-risked. We've drilled 1,600 wells as Tourmaline now, and the infrastructure is built and all in place. So logically it becomes a simpler and less expensive exercise going forward, and that's exactly what's happened over the past couple of years, and you've seen the dramatic improvement in our capital efficiencies. We began slowing our gas growth back in second half of 17 because of low commodity prices, and what that didn't affect was advance our migration to a free cash flow generation model. That started in 2018, continued in 19, and will accelerate from here. We're, as Myron was talking about in the last presentation, as you get older you become more debt adverse, so we don't like getting above 1.5 times debt to cash flow. We'll exit this year at about 1.1 times, and we have a pretty compelling 2020 investor profile. We're going to grow our cash flow per share by 14%. We're going to grow our liquids production year over year again by 20%, and we're anticipating a free cash flow yield of 8% with production growth in that sort of 6 to 7%. ESG is definitely topical, and this is the senior category, and of course being the gassiest in the senior group, the comps look good, so we have the lowest net CO2 emissions and by far the lowest emission intensity, and we've dropped it 64% over the past 5 years. So we've been working diligently on this for an extended period of time. Our sustainability report is out over the next week or two, and we have hard targets on where we're going from here over the next 2 to 5 years. Dave mentioned we are the largest gas producer in Canada, and that's despite dropping our growth rate from where it used to be at 20% per annum down to much less than that on the gas side. In the medium and long term, as a large fossil fuel producing company, we've always believed that nat gas is the place to be in the fossil fuel mix, and that mantra continues. And in the short term, being a local Canadian gas producer, given that our industry has lived with lower for longer prices, that constructive supply-demand rebalancing is further ahead in Canada, and you've seen that reflected in AECO and Station 2 prices. We put out our 5-year plan, or revised it in mid-December. We ran it on strip pricing due to popular demand, and so we've reflected the Topaz transaction through this as well, just the cash cost impacts. So it's a very robust plan. We grow at 6 to 8% per annum. We generate $1.75 billion of free cash over the 5 years. The use of that cash is for dividend increases, for share buybacks, and for debt reduction. So this is the base business of the company. In mid-19, we went to maintenance capital mode on 2 of the 3 core areas and retain growth in our Montney gas condensate complex because that has the highest returns of anything we have in the portfolio. And that will continue through the 5-year plan. This is, as I mentioned, the base business. Whatever we do with the approximately $1 billion of funds we've created with the Topaz transaction on the M&A front is obviously accretive to this plan, but they won't get rolled in until when and if they happen, and we're in no panic to rush that along. But it's probably about the most exciting time for the company in several years as we enter 2020. I'll just say a couple of words on each asset. Deep Basin, it is our biggest producing asset, but it's on maintenance capital mode now, so it'll stay flat at 175,000 BOEs a day. We've gotten to, right now, it's about 900 million a day of gas and 25,000 barrels a day of liquid. We've only consumed 10% of our inventory, so this someday will be a growth asset again, but for now, maintenance capital is the proper approach. So we're focusing on improving capital efficiencies, which are down to 7,500 per flowing BOE, and increasing the liquids production by biasing where the horizontals are landed into the most liquid-rich horizons. We are the largest Deep Basin producer, largest future inventory, largest plant network as well, as you look at that. And that interconnected asset, those blue barns are gas plants, and the squares are townships, so you get an appreciation of the land base. But our interconnected production is actually the largest gas field in Alberta. BC Montney gas condensate is the growth complex for the company, and it's really 2 sub-areas, our traditional Sunrise, Dawson, Ground Birch, and Gundy to the northwest of that. Both feature sweet, liquid-rich gas. Sweet's critical for us because it drives low OPEX, so our all-in OPEX across the whole map sheet is sub $3 a BOE. It is liquid-rich. It's not as liquid-rich as some of the Alberta Montney, so we're anywhere from 20 to 125 barrels per million. Some of the Alberta assets are in the 200 to 300 barrels per million. But the gas is sweet, and OPEX is somewhere between half and a third of those producers. We drill by far the least expensive completed Montney horizontals in the basin, so we're now at drill complete equip in both subcomplexes under $3 million. Gundy, we're at about 1.75 million to 2 million BOEs per horizontal. And so for $3 million, your development is $1.50 a BOE, or if you want to flip to gas, 25 cents an MCF. We'd argue that Gundy, of all the Montney subplays, has the best economics of all of them, simply because the gas is sweet. Your CapEx is about a third of the Alberta Montney guys, and the well performance continues to improve. So that's why it's the growth asset. We did start up our 200 million a day deep cut in mid-19. We'll follow that up with doubling or phase 2 expansion right now in the 5-year plan that sits late 21, early 22. And in that 5-year plan, that's the only growth project in there. We have all kinds of other projects that sit outside the plan right now. So Gundy has the growth. Sunrise Dawson will keep flat at about 325 million a day with its associated liquids. And during 2020, we'll morph into the 3rd largest Montney producer in Canada to go along with being the largest Deep Basin producer. We see those as Canada's 2 most competitive on a continental basis gas plays, and so that's where we want to be positioned. Infrastructure, we're the 4th largest gas midstreamer in the basin. We did do the Topaz transaction, but all we sold down was 5% of it, so we retained 95% of this infrastructure, which preserves our pristine operating cost structure, which, as I mentioned, is sort of sub $3 a BOE right now. Those 19 plants, our capacity for processing gas is about 1.55 BCF per day, and that's post Topaz transaction, and it essentially touches all 15,000 locations in the inventory. Capital efficiencies, 19 was our best year yet, and 20 is going to be even better, so we're kind of in that 7,500 per flowing barrel or less, and that actually is the best of the large caps in North America, so will become an increasingly more significant part of our IR story. Gas diversification has been touched on in some of the other presentations. We started on our process about 6.5 years ago, realizing we were going to be a large producer, and having all your gas just accessing either AECO or Station 2 was probably not a good risk management strategy. So we took out as much long-term firm egress on all the existing exit points in the basin at that time, and have been steadily growing it since. So we're moving about half a BCF a day to NYMEX price markets, so we have 6 of them. 300 of that 500 goes west. Most of it gets to San Francisco City Gate, and that, if you've been following U.S. prices, has been by far the best price hub. And just really in the last few days, it's broken down through $3 an MCF U.S. So that's been very helpful for us, and you'll see that in our cash flows over the next few quarters. And lots of other people started diversifying after this, to the point where it seemed like nobody had gas at AECO. We actually have between 350 and 400 million a day at AECO, and a pretty sizable volume at Station 2. And actually, the biggest improvement in all the hubs has actually been Station 2 over the last couple of quarters. The Topaz transaction, we completed what we thought was a very important transaction for Tourmaline shareholders in Q4, where we figured out a way to crystallize just a small portion of the unrealized value that is embedded in our company but not reflected in our stock price. That's everything from drilling inventory to 2P reserves to the overall infrastructure complex that we have. So we've crystallized about $1 billion worth of value, ultimately, how we calculate it going forward. And we've done it without affecting the underlying EP program, and an almost imperceptible impact on our cash flow that we'll see in 20 and 21. We were able to do it because we're low cost enough and we're large enough on the infrastructure piece, so that it really doesn't affect the ongoing business of Tourmaline. Part of what drove the timing is we see this as a generational opportunity. It's like when Tourmaline got set up in the second half of 08 during the financial crisis. There's an extreme value dislocation, and we wanted to have an ability to participate in that. We're debt adverse. We won't run our balance sheet up. So we've been watching this for a couple of years and have evaluated all kinds of assets and small companies, and now we have a way to participate in that and keep our debt metrics in exactly the same place. So we're, as I mentioned, very excited about 2020 and going forward. And it kind of floats into our, and this will be the last slide, our EP and IR strategy on a long-term basis. To get investor attention, I mean, the metrics tell you you have to be big, and so we plan to get bigger. We can grow supply anytime we want. We've got 15,000 locations, but growing supply is not the right thing to do for this basin right now. So we're just going to grow our proportion of the supply by utilizing M&A over the next couple years, and then we'll grow supply again when the price dictates that's what we should do. We're the largest Canadian gas producer. We're probably we are the most efficient in North America, so we'll continue to elucidate that story. And, you know, the investment thesis is investors can count on us executing that 5-year plan, which is that kind of 6 to 7% per annum growth with continually increasing free cash flow. And the uses of that free cash flow have been demonstrated. And then on top of that, and accretive to that, we have the Topaz transaction that we'll use expeditiously and judiciously. We're not going to rush into anything, but there will be transactions happening over the next several months. So we'll stop it there, and love to answer questions.
Great. Well, thanks for the overview. And I think, that's the first question at the top of my page is the Topaz transaction. I'm sure that's what investors are asking about in meetings these days. So I just wanted to see if we could pick your brain and get any hints on what Tourmaline is going to look like 2 or 3 years down the road. I guess, do you see this Topaz transaction along with any follow-up M&A activity that comes as a result of it as dramatically reshaping Tourmaline, or is this more a matter of playing to your current strengths as one of the lowest cost producers in the Western Canadian Sedimentary Basin?
I'd say almost entirely the latter. So Tourmaline's not going to change. We're going to execute that 5-year plan. The pace at which we do it, and we revise it once a year, is controlled by the commodity price. Acquisitions that are done will be within one of the three, or in the end it'll be all three of our existing core operating complexes where we already have the infrastructure footprint built. And what we're able to do is, we're one of very close, we're in the top 2, I think, of cash costs, but we're also the lowest capital costs. And so we're going to take advantage of those two benefits that we have. And so whatever we acquire, we can make infinitely more profitable than it is right now. So Tourmaline's going to look the same. It's just going to end up having a bigger piece of the gas supply.
Okay. And I guess, go ahead, Chris.
Sure. When we did the initial financing for Topaz of the $90 million of initial revenue, 2/3 of it was from the GORE and 1/3 of it was from the non-op infrastructure and associated third-party revenue, that backstopped by the taker pays on the 2 Tourmaline interest plants. The GORE component and revenue will grow according to our 5-year plan. Because it was on all Tourmaline lands at the time of the transaction in October. Newly acquired lands that GORE isn't on, so there is an opportunity to expand that, and Topaz would have to pay Tourmaline for it. So I think you can count on the GORE piece, that 5 to 7% growth that's embedded in the 5-year plan. Topaz right now is looking at both royalty and infrastructure deals with E&Ps outside of Tourmaline. Tourmaline has its own M&A strategy, and where it makes sense, where the cost structure is low enough, or there's infrastructure that Tourmaline doesn't need that comes with transactions, Topaz may participate in further deals with Tourmaline.
Go ahead.
Mike, Mark from C&Q was talking a little bit earlier about running down his gas because he can't meet his ROE type threshold. So what are you bringing to the table that they can't? I presume it's your focus on the Gundy side.
Well, it's our overall cost structure is so much lower, both on the cash side, so operating, and on the capital side. So we're significantly lower than anybody else on the D&C side, and so we can make money on a full cycle basis at $2 gas, but we're not going to grow our gas business at $2 gas. We're going to maintain it. Gundy, it being the one exception, is we've got a significant amount of liquid there, but it's always been important to us that we make a full cycle rate of return on all of our hydrocarbon streams, so that includes gas. So if we get to the point where we're not making a full cycle return on the gas piece of the business, we'll slow her down.
And just to come back to Topaz, we actually have 2 questions on the app that are somewhat related, so I think I'll just ask them. But first question, what is the ideal asset that you would add to Topaz? Is it freehold lands? Will you generate GOREs on another producer's land? And then secondarily, should we think about the Tourmaline Topaz M&A as being more focused on drilling opportunities and inventory or on cash flowing assets?
Well, I'll answer the second one first. I'd say the lion's share of the acquisitions that we're going to do with Tourmaline are going to be cash flow accretive either initially or very soon after. We have lots of inventory. Some might look like inventory, but they won't be in the end. And then on the Topaz piece, we're looking at both royalties and we're looking at non-op infrastructure with the take-or-pay backstops, which don't decline. So those things are very attractive, and there are players out there that I think are interested in perhaps pursuing those. So you'll hear more over the next 12 months on both sides of the equation.
And last Topaz question, I was just wondering if you could give us an update on the hunt for a management team for Topaz and how we expect maybe that to materialize over the next couple months.
I'd say that's your time frame, is you'll see it announced in the next couple months, and we're quite far along.
Terrific. Moving on, I just want to touch on ESG. I mean, you guys have, I would say, played up ESG a lot more on your website and your sustainability reporting over the last year or two. So I guess I just wanted to get a sense, similar to what we were asking from Mark, is what are you really focused on the ESG side in 2020? Perhaps what do you do that may differentiate yourself from other companies? And then third part of the question is, do you see any conflict in your desire to invest in environmental technologies that, say, reduce emissions versus competing goals of returning cash to shareholders and maximizing free cash flow? So,
sure. Well, I think I put the one chart up that shows we have a good start from where we are, and we've been investing in projects for an extended period of time. Everything we do on the emission reduction and environmental performance improvement aspects actually reduces costs too. And so it's really a double win for shareholders. We are absolutely measurably improving our ESG performance, but we're reducing costs all the way along. We have a mantra that, we look at the whole full cycle environmental performance improvement, so that's air, land, and water. We have the belief that not every company can do everything, so I think, we'll focus and have been focusing on 3 or 4 different aspects of improving our performance. And then other companies in industry will focus on a different 3 or 4, so that in aggregate, the whole industry improves. So our focus has been on water, and I think we're the basin leader in reducing the use of fresh water in fracking, and there is no doubt that our industry uses enormous volumes of water in the fracking exercise. So we've almost entirely eliminated, we're about 98% recycled water in BC. We're at about 70% in the Alberta Deep Basin. A little tougher to get that all in place because it's a pretty big stretch of geography. It's 225 clicks from one end to the other. And what we do is build these water recycling facilities. So there's a capital investment involved, and they're typically anywhere from $2.5 to $5 million, but we've got most of those behind us already, and we save per well on the BC side probably $200 to $300 per well on water. So when you're doing 200 to 300 wells per year, that adds up in a hurry. So that's what I mean. It's just a great story because you're doing something that is extremely important for the environment, and you're improving your cost structure, which the shareholders get a benefit from as well. We're kind of technology-driven people, so are at the company really from top to bottom. So we much prefer hard targets than aspirational goals. So I mean, if you looked at the senior group, from where we start, we got the best chance of being zero net emissions. We're not going to promise that, but we're going to give you hard CO2 and methane reduction targets that we're going to get in the next 2 to 5 years because we have a technology roadmap to get us there. So there's a number of things we've worked on. One was we're almost entirely off diesel with our drilling fleet and getting there on the fracking side for heating your water and running the frack equipment. Methane, we replaced 3,400 pneumatic controllers in the field, and Myron referred to those. They all produce a little puff of methane when valves are changing and so forth. We've got those all changed out. It's on a CO2 equivalent basis, 200,000 tons a year. It's got about a 2.5-year payout, right, if you looked at it. So, and then the last thing I'll say is on the industry corroboration piece, on the gas side, NGIF, which some of you may or may not have heard of, Natural Gas Innovation Fund, and initially it's 7 companies, and that's where we work together. It's similar to COSIA on the oil sands side, but it's on the gas side, and develop technologies for the improvement of industry at large. It actually started on the downstream side in Ontario with the consumer, and so it's more efficient furnaces, waste heat recovery, and then we weren't involved in that. We were involved in getting the group together On the upstream side, we're working on the midstream side, and the net goal is that, we'll have a net cleaner methane molecule, and the mantra will be from drill bit to burner tip, and that's what we're working on right now. And Canada already produces the cleanest net methane molecules in the world. That there's no doubt about that, and this is just going to make us that much better.
Interesting.
So,
okay.
Yeah.
I think Paul had a question.
Just getting back to the Topaz structure, does that mean in the future that you will only acquire assets with that new structure, and you will not be a consolidator of public companies over the next 5 years, especially if AECO stays at $2?
Oh no, we're going to be. Tourmaline's M&A business is independent of Topaz, and Topaz is going to, Dave referred to it, I mean, we've got an independent board when we set it up, but we're going to put an independent management team in there, and Topaz is going to go off and be a separate company. And then,
Acquire lame ducks in the future, lame public ducks.
well, how about undervalued assets? Undervalued assets. Yeah. Yeah. Absolutely.
All right, I guess just moving on to the next topic I want to address is, you touched on it earlier, but natural gas pricing has obviously been very weak to start the year. So you had a good slide in there where you talk about all the different hubs that you guys sell your natural gas into. So I was just wondering if you could kind of address that issue for people that might be concerned when they see the NYMEX quote these days. And, what's Tourmaline going to do to manage through this period of gas price weakness over the next, 6 to 9 months here? What levers do you have to pull, or, strategic options do you have to kind of manage around some of that?
Sure. I think we're pretty well positioned right now. I mean, Henry Hub has definitely gotten battered more than people thought. But we've had similar improvement in AECO and Station 2. And then 60% of what we ship to the U.S. is in that California market, or Malin and California combined. But most of it we take right to San Francisco City Gate. We have, 11 or 12 customers that we sell directly to. We have a storage position both at Dawn and at California, so we've gotten very, very sophisticated on managing what our net realized gas price is going to be. The reason AECO and Station 2 are, it looks a little stronger is we've had more pain for longer for Canadian producers suffering with low AECO prices, and Station 2, until recently has been even worse. And so the supply-demand rebalancing has been going on longer in Canada. In the United States, the combination of weather and oversupply has really hammered NYMEX in the short term. But the Americans are very good at rebalancing, and so I think you're seeing the producer response from a capital spending standpoint. You're actually almost starting to see the production response already. So, I mean, there are, we read all the same stuff everybody else does, but, I think people are feeling better about U.S. gas prices for late this year and heading into next year. A very high oil price would, the black swan in that is the Permian and associated gas. And oil prices have come off a little bit, so I don't see a whole lot more associated gas coming on. So we're always constructive on gas, as you know, but I think the Canadian gas story looks a little stronger than the U.S. gas story right now. And we hedge between hubs. Like, we have a very sophisticated marketing effort going on, and we're doing exactly the same thing on the liquid side now that we're kind of plus or minus 70,000 barrels a day. We're trying to duplicate that diverse sales point, own your own transportation mantra that we've had on the gas side, on the liquid side.
Right. And we only have time for one more question, but I wanted to ask you about the NCIB. You guys instituted your first NCIB in the middle of last year. You were active on it through the second half of the year, and I should point out as well that you personally have been buying back a fair amount of stock in January as well. So, how do you guys plan to manage the NCIB going forward in 2020? Can you just talk about whether it's stock price dependent, valuation dependent, et cetera, and how active we should expect you to be on that?
I think our mantra has always been it's tactical. We're not going to have a program buyback, but we do use it when we think the valuation disconnect is extreme, or on those days where there's no buyers at all. So in aggregate, we bought about 1 million shares in Q4. I think the average price was sort of around $12.75, $12.80. So we'll continue with that. We do have a lot of free cash flow coming out of that 5-year plan is 1.75 billion, and that is one of the 3 silos. So it's something we communicate internally and communicate with our board regularly on, what is the mix between share buybacks, dividend increases, and just plain simple debt reduction, which Brian and I always like.
Terrific. And with that, we are out of time, so probably could have used another 20 minutes, but we definitely appreciate you dropping by, and